Hi everyone, welcome to our LinkedIn Live. We're both from Roberts, Crosbie and Mortensen Lawyers. I'm Amanda Crosbie and I head up our business and company team. I'm here with my colleague Hamish Taylor, and we both work on a lot of sales of business and business acquisitions in our practice. So we're here to talk to you about the top 5 questions we get from a lot of our purchaser clients when they're looking to buy a business. So I think we've got 5 questions that we'll run through and see if any questions come through along the way. First up, we've got, should I buy the shares or buy the assets? So that's a typical question we get from a purchaser looking at acquiring a business. It's not a black and white answer, but it depends on the situation, the business and the client. So typically a purchaser will prefer to buy the assets over the shares. Because when you buy the shares, you're not only acquiring the assets of the company, which is including the business, you're also taking on pre-completion liabilities, which can be unknown. So, for example, if you're looking to buy a construction business, there could be 6 years worth of claims that you're not aware of for defective works, etc. That no claims have been made. So even though you carry out your due diligence, these claims might come out after the fact, and you're going to have to deal with them if you buy the shares in the company, because you're taking on the assets and the liabilities in the company in its entirety. So that's why some people do prefer to buy the business. A lot of purchasers do, because they don't have to unless it's agreed that they take on those liabilities. You still end up with the same assets. The business, the tangibles involved when you buy the assets of the business. However, it is a bit more of a complex transaction because buying the shares, you just buy the shares and that's it, you own the business. But transferring the business, and the assets, you might need to transfer employees, leases, key contracts, actually register assets, things like that. So it can be a bit more complex, time consuming, few more hurdles, I guess, if third parties don't agree to the assignment or the transfer of certain contracts. And then I guess there's also commercial reasons why people prefer the sale of shares. So if there are key contracts that can't be assigned or third parties won't agree, then you might be forced to buy the shares. Or if for whatever reason a purchaser doesn't want clients knowing about the sale and just wants to sort of come in and take over and everything sort of remains the same. So yeah, it really depends on the business and what's happening, what contracts are involved, that sort of thing. But they're the type of stuff we talk to the clients about.
And I would say that, the majority of purchases we would do would be asset purchases, simply because of the risk profile and how we can minimise that for our clients. If you take on the assets, you know what you're buying, whereas if you buy shares in a company that owns a business, as Amanda said, it's really that issue of liabilities that are floating around out of there. Key of those could be tax liabilities, for example, and that's why the majority of purchases are done by way of asset purchase. However, when we act for the bigger end of town, they might prefer to buy shares in a company as such, because it's just a little bit more seamless, and from the outside looking in, nothing really changes.
And I guess if we do act on a share sale, that's when you want to really negotiate your vendor warranties and securities, etc., in your contract. So the sale contract on a share contract is
a little bit more involved.
Probably more, much more negotiation involved in that. But once the contract's in place, it's actually a fairly easy transaction thereafter.
Yeah.
So the next question we have is, what legal entity should I use to buy the business? And again, very lawyer question, but it depends. Depends on the business you're looking at buying. It depends on your personal situation. Depends on your goals and your growth goals, etc. And there's a few things that need to fall in line for you to determine ultimately what the best structure is for you to move forward with your purchase, and that's tax minimisation strategies that are available to you, asset protection, and also just commercial considerations. You don't want to put in a super complex structure when it's not necessary, because that comes with costs and just compliance and everything like that. A very typical structure for a sale of business would be a company structure that provides asset protection subject to director duties and obligations associated with the company. And then you would typically have a shareholder of say a discretionary trust, a family discretionary trust, if you do have the ability to stream income to various beneficiaries, or just another holding entity, another holding company. If you don't have, tax minimisation sort of benefits of a family discretionary trust, and you can use that holding entity to then invest elsewhere, depending on the risks associated with that.
And if you were going into business with somebody not within your family, but you still wanted the benefits of the trust, we can look at unit trusts, for example, which are another well-used entity to buy businesses.
Yeah, so it just definitely depends on the person's situation,
It's really a way up here between our legal protections for our clients versus accounting protections. So it pays to talk, or have the lawyers and the accountants talking on this one.
Yeah, definitely. So, and the decision should be made prior to the sale agreement being executed. So consult your solicitors and accountants. We like to get the accountants involved definitely on structuring advices, just because the tax minimisation benefit of certain structures is significant, or can be. So yeah, get everyone involved at the beginning, because if you put a structure in place and then want to try and restructure or sell, restructure into a different entity, there are CGT implications typically, and also maybe some logistical issues. So you want to make sure that you're having that conversation with your lawyer and accountant as soon as possible, basically.
Up next, third question is, what is the process to buy a business? From our end as lawyers, we would generally be approached after a client has targeted a business or found a business. How that happens, generally through use of an agent. And as a buyer, most of our clients will have probably signed an NDA or a confidentiality agreement, so that they can enter into negotiations with a potential vendor, the seller of the business. The next step in the process after preliminary discussions is quite often coming to a heads of agreement, which can be a relatively short document that sets out the key aspects of the purchase. Probably number one is purchase price, also timing around the purchase, when it's to happen, who is to do what. And the heads of agreement is generally a non-binding legal document, but it really is useful for clarifying the intentions of both parties, the seller and the buyer, to move forward into the next step, which would be where we come on board and have a lot of input, which is the purchase agreement. And an agreement for sale and purchase is a legally binding document. It will, again, depending on the type of transaction, whether it be a share sale or an asset purchase, cover off the key points: purchase price payable, when the transaction is to occur, if there's any preconditions to the purchase, for example, getting landlord consent, or if you're buying a franchise business, getting franchisor consent. Is there anything else the purchaser wants to do or know about the business, being due diligence basically. The agreement will run through what is to happen before settlement and completion, what is to happen on settlement and completion, and then what is to happen post settlement and completion. Which would probably lead us into the next question, which is due diligence. And what types of due diligence are there? And a lot of our clients are asking us, what kind of due diligence should they do? In simple terms, due diligence is doing your research on the business you're about to buy. You are looking to analyse pros and cons. You're looking for risks in the business. You're looking at or for any red flags. And I guess there there are the three main types of due diligence would be commercial due diligence. This is quite often left to the buyer to do their market research. They might engage agents to do so on their behalf, but that's really looking at the market positioning of the business, where it's going, what's it doing, what kind of industry it's involved. Second up would be accounting and financial due diligence, obviously taken care of by the accountants. And thirdly would be the legal due diligence, where we come on board. And what we do for clients will vary depending on the nature of the business to be purchased. It can, depending on timing, depending on cost. If we're acting for the big end of town again and they are throwing a lot of money at us and don't want to leave any stone unturned, then we can be instructed to look at every contract that applies to the business, service contracts, supply contracts, client contracts. We can go through each contract, identifying risks or problems. If we are dealing with the smaller transactions and we have clients entering into, say, for example, the franchise businesses, we could be engaged to review franchise agreements, disclosure statements. One key one would probably be looking at your lease, to make sure your lease that you are intending on taking over, which secures the business, is in place, valid, that you understand the commercial terms of the lease, and what kind of tenure you've got there. And I guess one of the key points I make here to my clients is that coming to the end of the due diligence process, it's important for clients to not only speak to us as the lawyers, but to have the lawyers, the accountants, and themselves involved in a discussion to make sure that we're all communicating, and that there's nothing being missed by one of us when we're doing it on our own. So that's a very important point to keep in.
And I think with the legal due diligence side as well, the key contracts are really important. So we can have a look at those to see whether they can be assigned and the process for that. So that might dictate whether you decide to proceed with a share sale or a sale of assets as well. And also look at, there might be a relationship that the current vendor has with a key client and there's no actual contract in place. So just giving you advice on, well, that's all good and well that this relationship's been there for 20 years, but how can we guarantee that this quite large client will stay on board, if you do come on over, if there's no actual contract in place to, bind them to your service in the future. So that might be a discussion about how we deal with that, and then we look at earn-outs, potential earn-outs and things like that. So the due diligence is something that you do at the first stage, and it really then dictates, it can dictate how you proceed with the transaction and what additional terms that may need to be negotiated depending what you find out.
And we'll have our checklists, and we will take our clients' instructions on how in depth they want to get with due diligence. We can break it down into components. We can look at different aspects of the business depending on what industry the business is in. And
IP is the other one. So, are they registered trademarks?
Yep.
Have they registered all the IP that you want the benefit of? There's no point buying something if it's not adequately protected. And if they haven't, can we do it after the fact? And are there going to be any hurdles to doing that? So, just doing basic searches if there are trademarks in place to see whether a trademark would be successful after the fact. And that might mean a negotiation on price if the advice is, well, it's questionable whether we could register.
Yeah, so really with the due diligence, we're looking for red flags from a legal due diligence perspective, and we're also looking to make sure that the business that is being purchased can be transferred across, the assets can be transferred across in full to the purchaser come settlement.
Yeah, and the other big one is security interest registered on the PPSR. So the personal property security register, if you have a security against a third party, you should register on that forum, which is an online website. And typically in any sale of shares or sale of assets, the sale will need to be free of encumbrances, so free of securities. So we undertake due diligence to make sure that what securities are registered over those assets, and during the completion phase, make sure that the vendor removes all those security interests registered
We want to make sure that our clients that are purchasing a business are paying good money for assets that they are going to own and hold 100%. That there's no charges over those assets coming across at all.
So then that brings us to our fifth question. What happens to the existing employees? So this is a big one that a lot of clients want to know about, obviously, particularly in a sale of business or sale of assets. So a sale of shares, as the employer doesn't change, then nothing really needs to occur. You obviously probably want to tell your staff, depending on the size of the company you're acquiring, that there is a change of hands, and if it is a smaller business and they know the owners, then introduce them, etc. But nothing really needs to occur. You just take on the employment contracts as drafted, etc. And you take over all employee entitlements because they're a liability of the company, and you're taking on the shares of the company, ownership of the company, that all stays. More complex is when you buy the assets or acquire the business. What happens to the employment entitlements is negotiated in the sale of business contract, and it's also governed by the Fair Work Act. So you can't agree to just anything. There are deemed provisions in the Fair Work Act that relate to the transfer of employees. And for example, if you do take on the employees within 3 months of the sale of business, it's a deemed transfer under the Fair Work Act, which means that certain entitlements and rights of employees must be recognised with the new employer, but you can choose to recognise other employment entitlements, which is a very brief summary. And so I guess as a purchaser, your first decision will be, do I want to take on these employees as if you buy the business, because you don't have to take on employees if you're buying the business. And if you want to take them on, then do I recognise prior service for certain things that you can choose, such as annual leave? You can choose whether or not to recognise prior service in terms of annual leave. And that's a commercial decision. Obviously, you're taking on entitlements and then the obligation of giving them the leave in the future. But also for staff satisfaction, you might choose to take on those annual leave entitlements, because people then feel like maybe they want to stay longer because they know they've got some holiday leave, etc., up their sleeve. And then, it's then a negotiation on the purchase price, so there can be settlement adjustments depending on what you agree to discount the entitlements you have to take on. Sick leave is a big one because sick leave is not a guaranteed leave, whereas annual leave is. So when they resign, you've got to pay it out. But sick leave, particularly with staff that have been around for a long time, the sick leave entitlements might be quite significant, but it's then a negotiation on what adjustment you'll make if you're taking on that sick leave. It might be a 25%, 50%.
Yeah, I'd say that when it comes to employees, the two biggest issues to deal with, I guess, are when you tell the employees, and that needs to be worked out between, if you're the buyer, with you and the seller. Most people selling a business will not want to tell employees until they have a binding unconditional contract in place at least. And then as the buyer, it's identifying those staff which you want to take on, and then it becomes in many ways a matter of appeasing or keeping those employees happy. So therefore, when it comes to entitlements and as to what are going to transfer over, if the employee wants their annual leave to transfer over, then it can transfer over, then it can be beneficial to the purchaser to do so. Whichever way it's done, there's generally an adjustment done on the completion date. And what we mean by that is that we have a statement that sets out the purchase price. If, for example, a stock take was to happen on the morning of the purchase and that's been done and completed, we could have the stock figure in there, and then we'd also have the adjustments for annual leave if any, if sick leave or paid parental leave was going to be paid out. So.
Yeah, and the only other thing I guess to note with employees is that under the Fair Work Act, you have to offer the transferring employees at least the same terms or similar terms that they're currently on. So you can't decrease their wage, for example.
No less favourable, isn't it?
Yeah. And I mean, if you're buying the shares in a company, you can't do that either, or you can't just you can't just let staff go unless there's a genuine redundancy or a genuine performance issue, etc. So you don't have the flexibility, I guess, of picking and choosing the staff if you're taking over the shares rather than buying the business. You've got that flexibility, whether you take them on or not, but you have somewhat limited flexibility on negotiating terms because of the provisions in the Fair Work Act protecting the employees.
But yeah, the key point there is that if you're buying a business by way of an asset purchase, when it comes to employees, the employment ends with the seller on completion. And if the purchaser elects to take on the employee or staff member, then it starts again with the purchaser moving forward.
Subject to the
adjustment of their leave.
And the particular entitlements that you need to recognise prior service. So like there are sections of, the Fair Work Act that require you to recognise that prior service when calculating different entitlements. But I think that's all.
That was the top 5.
Hopefully you found that helpful, and if you have any other questions, please feel free to give us a call. We have a 15-minute free case evaluation, so give us a call, have a chat about anything we discussed or anything else that you want to hear about acquiring a business or shares.